Welcome to the Maine Money Show, where Wall Street meets Main Street. My name is Cynthia DeFazio, joined today by Jordan Maine, president of Maine Financial Group, as well as joined by Adam Freund, CRC with Maine Financial Group. To our viewers at home, are you asking yourselves what is going on with this new tax reality? What's happening with this one big, beautiful bill? How's that going to affect my retirement? Well, today's show is just for you if you're having those questions at home. Jordan, how are you today?
I am great. I'm happy to be back in the studio. How are you?
Wonderful. Thank you so much for asking. I'm also happy to be back in the studio. Adam, how are you?
Well, I am absolutely just peachy.
Yay!
But something looks very different about this set. There's added material or something on this set.
I was thinking the same thing.
What that is.
I don't know. Is it the mugs?
No, the mugs. Oh, but look at this, a brand new book.
Yay!
And this has been written by my friend, colleague, and Maine guy. Get it?
There's a pun. I saw what you did there.
That was good.
Jordan Maine, and we'll get into this a little bit more, but this is a book that he actually wrote for the general public. It is not a what they would call a sales book. This is really about, one Main Street millionaire, and I think the subtext says how real people build real wealth and keep it. So more about that coming out very shortly.
Wow, Jordan, congratulations.
Thank
I
you.
love that. I cannot wait to read it cover to cover because I know it just came out. So I am so excited. And thank you for bringing it to the studio today.
Absolutely.
I love that. So obviously, well, I know we have a lot of changes to talk about, but let's have fun for just a second. If you both woke up one morning and you were the mayor of your town, what would you do? What's something that you would do? The very first thing.
Oh, I would make all golf free for mental health awareness.
Lord.
It relaxes you to play golf.
Well, here's the weird thing about that, because exactly, I was going to say almost the same thing. If I was the mayor of my city, I would buy one of the municipal courses in the area and make it free to all the
Well,
residents.
come on, you can't copy me. But I guess it must be a good idea.
All right, then I get rid of all the curbs.
I love it. Well, can I play too?
Sure.
Yes.
I would make it official that everyone would have to smile at everyone that they see that day. I know that sounds corny, but with so much going on in the world right now, what's better than smiles, right?
Amen.
I
Amen.
Pass it
agree.
along. We're going to put that into law.
There you go. Fantastic.
Well, let's talk about this. With all the leadership changes, Washington just came out with the one big, beautiful bill, this Maine tax law, if you will. But how does it affect retirees here in Michigan is what I'm trying to ask. What should they be watching out for right now? Jordan?
Yeah, well, there were multiple things that changed. Some of them were, let's start with what stayed the same, right? So the tax brackets all got locked in and became permanent, right? So we are, I think, in the third lowest tax bracket environment in history. But then they added some things too, which is unique. So with some catches, anytime the government does some things, there might be a catch. Let's look at the SALT tax, the state and local taxes. That's where you can write off your property taxes on your house. It went all the way up to $30,000. Except if you make too much money, it begins to phase back to where it's been at 10 for many of years. So people making under, I don't know what the amount is. I think it was under 400,000 or 500,000, or
yeah, something like
or
that.
we'll have to check that. But they can get up to 30,000 as a deduction there.
Oh, wow.
Also, tips and Social Security or overtime. I'm sorry, tips and overtime up to a certain amount are going to be tax-free.
Tax-free and for a limited time. I think it was 2028 is when that sunsets.
Right, 2028. It was 25,000 and 12,000. So there's some breaks for people that have overtime and tips, but not too much.
Okay.
And then the other neat thing was deducting the tax when you buy a vehicle.
Okay.
So again, that has some limitations on income as well. So more of the same and some new things.
Okay. Anything going on with the Roth 401ks, IRAs, any changes there?
Those are all stay the same as they were. So that extended, but the argument here is since we're in such a low tax environment, people were so rushed to get to the end of 2025 to convert as much as they can. Now they can take their time and do some real tax planning, converting from IRAs to a tax-free Roth IRA.
Yeah, before this came into effect, we thought we only had this very limited time at the end of 2025 to get all of this rushed in, get your Roth conversions done. But now that they've made this permanent, and of course, permanent, we don't know how long really permanent is, but we know that those tax brackets, which are very big in between each section. I don't even remember how high does it go? What's the top tax bracket? It's over 700,000.
It's over 600, yeah.
600 at least.
Yeah, I think it's closer to 700. Yeah, it goes.
And which it contrasts to the highest tax bracket that we've ever had in this country was during World War II, which I know Jordan has mentioned before on the show. But I still can't get over that. If you made over 200,000, you were taxed at 94%.
Wow.
So every dollar over 200,000, 94% of it went to Uncle Sam.
Oh my gosh.
So.
And then if you
Wow.
lived at that time in the state of California, they had a 6% sales tax. So
You made nothing?
You made nothing. Yeah, back then. You know, the other thing that they did in this bill was the senior citizen, I can't remember what they called it, but essentially to make Social Security somewhat tax-free. So each retired person gets a $6,000 additional credit. They did some math, and that's going to, over 80% of the senior citizens now will not pay tax on Social Security.
Oh, wow.
There's a formula involved with it. I think it'd be a lot easier if they just said Social Security is tax-free. But so a majority of people will now get Social Security tax-free, but some will still pay tax on Social Security.
Which we've been
Okay.
advocating for Social Security to be tax-free for quite some time. I mean, it is kind of silly that, I mean, we all get taxed to put into Social Security, and then once you start taking Social Security, it's the threshold of earnings is very low that you start getting taxed. Does that include RMDs? Would you get, if you started taking your RMDs, required minimum distributions for those of you out there in the audience?
Yeah, when you get over, let's see, with 73 and up, depending on the year you were born, you have to take money out of your retirement accounts and claim that as income tax. And as Adam is saying here, that could trigger a tax on your Social Security as well as tax on your Medicare premiums.
Oh, I didn't
So
think about
the
that.
tax
Wow.
planning is probably the number one biggest reason to plan in retirement to not fail.
Okay.
Yep.
Anything with Medicaid eligibility, did that change with the new laws that are into place?
Well, yes and no. I don't
Okay.
know the exact particulars. All I know is that if you need Medicaid, that's not a great situation that you've put yourself into.
Okay.
That means you don't have any money.
The
Essentially.
point I think there's some language around verifying work and things in that nature. They're
Yes.
trying to get rid of the fraud in the Medicaid to say if you're working and you have a income that you're not reporting, you can't also collect Medicaid. Medicaid truly should be for the people that are out of work or don't have any other assets.
The
So
most despaired people. That is correct.
yeah.
That makes perfect sense. So all these changes people should be aware of. So what does this mean for retirees right now? I know we're going to take a commercial break in a moment, but that's amazing. All of these things people should be thinking about.
Well, I still think, especially going into retirement and also those that are newly retired, Roth conversions are a major thing that you should be considering. And you can't just do it willy-nilly. You've got to have a plan in place. But we actually have a website that you could go to if you really want to, and that is our maintaxbill.com, maintaxbill.com, and that will give you the ability to do, it's our own calculator. I think you have to put in how many different...
Yeah, it's a free tool. You put in a few pieces of information, your age, how much money you have in your retirement, what you think your tax bracket will be, and you pick a rate of return that you want to get. It's a great tool. You can play around with it as much as you want. When we come back from our break, I've got some examples of how different people have used that.
Okay.
But I think that is a number one thing now that we know what the tax code is going to be, is to jump on tax planning.
All right. Well, Jordan, I get to be mayor for the day. So I'm going to say we're probably going to take a commercial break. And I think you should give away your book if they book an appointment.
Whoa.
What do you think? I get to be mayor.
I think we're going to have to do that. So yeah, the offer is here to call your number on the screen or click the QR code. Come in for 2 meetings out of your life and get your own free, what we call your RIP report. That's your own written financial plan, RIPT. Evaluate the risk you're taking in your portfolio. Make sure you have an income plan, not an income guess. The P is your portfolio health. Make sure that you're healthy in all of your investments. And the T is what we talked about here today, the tax plan. But as Cynthia said, we will also give you a copy of our new book.
Yay.
So call the number or click the code, and we'd love to see you in one of our 4 offices.
Jordan, thank you so much. Adam, thank you so much. To the viewers at home, the number to call is 462-7839, 888-462-7839. Don't forget, if you book your complimentary consultation, you will receive a copy of Jordan's new book. We're going to take a very short commercial break. When we come back, we're going to talk about, are there some hidden traps in the new law? You're going to watch this next segment if you're asking yourself that same question at home. Stay tuned.
I was an accountant by trade out of school, out of Michigan State, and I absolutely hated brokers, financial advisors, whatever they wanted to call themselves. I was a tax accountant, and we would share a mutual client, and this broker would advise our mutual client to buy, sell, and never do any tax strategy, and I was left to clean up the mess. So I went to the client and said, please talk to your broker and tell him to knock this off or begin to do some strategy, and the typical broker response was, I'm not licensed to do that. I can't talk about taxes. So I basically decided to get my investment securities license and all my other licenses out of spite so that we could do all the tax planning as part of the investment strategy for our clients. The value of choice, as we always say, if you go to a big box firm, they're going to have one of 6 portfolios, let's say, and you're going to fit into one of those. The value of working with an independent advisor, especially a fiduciary like we are, is that they have to do what's in your best interest, and they can use any program that's licensed out there in America. So a huge difference. After 20 plus years on this side of the fence, I think our industry does a poor job at explaining to the public the difference of those two. I come from a culture of helping people and educating them, not just telling them what to do. So I think people that truly want to educate make a big difference in this industry.
Welcome back to the Maine Money Show, where Wall Street meets Main Street. My name is Cynthia DeFazio, joined today by Jordan Main, president of Maine Financial Group, and Adam Freund, CRC at Maine Financial Group. And we're talking all about the One Big Beautiful Bill. And how does that benefit you? Are there any traps that you should be aware of? That's what this segment is all about. So, gentlemen, obviously, let's talk a little bit about that. Are there some traps that people can fall into if they don't have the proper guidance affecting the Big Beautiful Bill?
Well, yeah, go ahead. I was just going to say, the one trap that people don't seem to understand is that they enter into retirement and think that they have, let's say, $1 million, and the $1 million is in their 401k. Or they have an IRA, they have $2 million, and they'll come in and say, hey, I've got $2 million. And we have to say, actually, you don't. You don't have $2 million, because who's their partner?
Uncle Sam.
Uncle Sam. Uncle Sam is their partner. So that can reduce their as much as up to 30%?
Well, across the board, if you are triggering too much income out of your retirement accounts, there are multiple side effects that can happen from that, right? So they make you take RMDs out in your 70s, but you may be taking money out earlier. You may trigger, as we talked about earlier, excess Medicare premiums, so you'll pay more. You may be phased out of some of these new deductions, the deduction for buying a vehicle, the property tax deduction.
Salt.
The salt cap, exactly right. So it's imperative to make sure that you're in control of all your taxable income. We talked a lot about our tax calculator on the previous segment, but I ran just a quick one while we're at commercial break here. And this is just a 65-year-old, $1 million in their retirement account. I put in a tax liability of 25%. You can put in whatever bracket you want. And I just threw a 5% growth rate in there. And it has everyone living to, I think, 95 in this calculator. And it says, if this person converts right now, 25% of $1 million is pretty easy math. They would owe $250,000 in taxes. Now, if they did it all at once, it would be more because of the tax brackets, but they could do it over a few years and keep that 25% bracket. If they don't convert to a Roth IRA and keep it till 95, they're going to have earnings, RMDs, and then when you take the RMDs out, reinvest it, that $1 million is going to cost them a total taxation of $986,000.
Wow.
So think about that. If they convert now, they'll pay $250,000, or they can not convert and spend nearly $1 million in tax. That's almost a $750,000 savings. That's on a 65-year-old.
Now, wait a minute, folks. This is very serious because he put his readers on.
They are cheaters.
They are cheaters. But it's serious. So.
And so then I said, well, wait a minute. What about someone that's a little younger? So I took the same input factors, $1 million, 25% tax rate, 5% rate of return, and I did it on a 55-year-old. Would you believe that that $1 million IRA over that 40-year life from 55 to 95 causes total taxation of $1.6 million?
1.6.
Or they can convert it and pay $250,000.
Wow.
That's a $1.3 million tax savings.
So wait a minute.
Oh my
You're telling me
gosh.
if they have $1 million right now and they don't do the conversion, by the time they're 95, they will have paid more than what they've saved up right now.
Absolutely.
Oh my gosh.
That's crazy. That's absolutely crazy.
That is crazy.
Yeah.
Let's talk a little bit about IRA inheritances. Are they still subject to the 10-year rule for beneficiaries? Talk a little bit about that one.
Yes. The answer to that is yes.
Okay.
What they used to have is what they called a stretch IRA, which meant that it was based upon the beneficiary's life expectancy, whatever that is. I think they used 84 or something to that number. And they used to let you take the inherited IRA over that period of time. But now that number has shrunk to 10 years. You have to have it vacated within the 10-year period. And for those of you in the audience that might have high income earning children or about to be high income earning children, you're now causing them what we like to say a tax bomb.
Wow.
It's going to go to their income. And what do we do with money that's in an IRA? Well, they don't want to just see it sit there flat, right? So we try to grow that IRA, and now you're causing an even bigger tax
What
issue.
people don't realize is that that IRA to your kids is they pay income tax on it at their particular bracket. So if they're already earning a good salary, now it's even higher. And we're wasting tax dollars. That's why it's so important to consider a conversion to a Roth IRA. And there's other reasons. Once we're into a Roth IRA, if we can move those dollars effectively, now we can get Social Security tax free.
Yep.
We have bare bones Medicare premiums. And how about another little nugget for you here, Adam?
Yeah.
Let's talk about long-term capital gains.
Ah.
For a married couple, how does that work in 2025? The first, now short-term is different. That just gets taxed at your ordinary
normal
income. But long-term, these are stocks that you've held for a long time and you're scared to sell them because there's a big gain in there, right? The first $96,700 is zero taxed if there isn't any other income.
Wow.
So if we think about this, Roth IRA money is not taxable.
Okay.
So if I have all my money that I'm taking as income from Roth, Social Security's tax-free, all of this is tax-free, and I had $125,000 capital gain I'm worried about. I could sell that stock. You then can deduct your standard deduction, which is a little over $31,000 this year in 2025 for a married couple. That takes us down to $94,000 of taxable income on that gain.
Yep.
It's under the 96, 0%.
Wow.
Now, if you had taxable income from a 401k, now from 96,000 to 600,000, you're at 15% on long-term capital gains, and anything over 600,000, you are at 20%. So this idea of getting dollars from a pre-tax IRA 401k into a Roth IRA is several-fold, not just the initial point of doing it. You can benefit so many ways.
Which is important to know that a diversified portfolio is going to have money in probably all three buckets, right? Because not a lot of people can actually convert the entire amount. If you got $2 million in an IRA, it's tough to convert that amount. We can do it, but it's tough to convert that. But if you had some in the IRA, some in a taxable bucket or what we call a non-qualified bucket, a brokerage account, and then some in a Roth account, now you've got this whole diversified portfolio. And as Jordan just said, there's a portion of that stuff that's in a normal, regular, non-qualified brokerage account could be tax-free.
Could be. Yep.
Could be.
Adam, thank you. Jordan, I think we should give people the opportunity to call in, book that consultation, and get a copy of the RIP report and the book. What do you think?
Yeah, absolutely. So call the number on your screen, click the QR code, come in for two things: your own personalized RIP report. This is a report that's written just for your situation, RIPT. The R is to make sure you're taking the risk that you're comfortable with. The I is the income. Make sure that you have an income plan, not an income guess. The P is an overall health of your portfolio. Put that portfolio on a stress test. And the T is what we've been talking about here today. Get a tax plan in place. 2 meetings out of your life. We have 4 offices around Detroit. We have Troy, Bloomfield, Northville, and Brighton. And we'll throw in a copy of my new book as part of the process.
Maybe he'll sign it for you.
Ooh, that's awesome. Jordan, thank you so much. Adam, thank you as always. To the viewers at home, the number to call is 888-462-7839. 888-462-7839, or you can click the QR code at the bottom corner of your screen. You're going to book your complimentary consultation, and you'll also receive the ripped report and, of course, a copy of Jordan's book. We're going to take a very short commercial break, but are you asking yourself, well, what should I be doing right now to prepare myself for all of these new changes? We're going to dive into that when we get back. Stay tuned. We'll be right back momentarily.
A recent MarketWatch story followed a 63-year-old who had everything mapped out for an early retirement until the market dropped. Overnight, his confidence was shaken. Years of saving and planning suddenly felt uncertain.
It's a familiar story, especially when headlines are filled with volatility and downturns. But the truth is, retirement doesn't have to hinge on market timing.
With the right plan, you can build a retirement strategy that prepares for uncertainty. It's about balance, growth for the future, protection for now, and a flexible income strategy to help you stay the course.
The markets may fluctuate, but your retirement doesn't have to. A diversified strategy built around your lifestyle and goals can help you retire and stay retired.
Welcome back to the Main Money Show, where Wall Street meets Main Street. My name is Cynthia DeFazio, joined today by Jordan Main and Adam Freund of Main Financial Group, and we're talking all about the one big, beautiful bill. What do you need to know, and how do you navigate through the changes? So, gentlemen, that's my question to you today. What should people actually do right now to prepare for these changes? They're probably wondering that at home in the audience.
Well, I would say the first thing you should do is come in and see us.
Yes.
That's kind of selfish, though, to say that. I definitely would be talking to your own tax professional if you have one. Of course, we're able to talk about taxes because we've got Jordan Main in our office. But the other thing is, I think Roth conversions would be my number one.
Yeah, I know we're beating a dead horse here today to talk about the Roth, but I think it's so powerful. Also, if you don't need your retirement account, the worst thing you can do is give it to your kids. It really is. It's one of my our fellow advisors in Cincinnati used this analogy to say, imagine throwing a great wedding for your daughter, and she's so happy, and it's such a great night, and then you hand her the bill at the end of it. And
Yeah,
that's kind of what giving a retirement account. Here's a great retirement, and here's a huge tax bill that comes with it.
Yeah.
Right. So if you don't need your retirement account, or at least some of it, we can show you how to put it into what we call an IRA legacy plan and turn that into a tax-free event for your children. So I think the question that you asked, Cynthia, is where should we start? Start from the beginning, right? A goal without a plan is just a wish.
Yes.
It starts putting a tax plan together for your income while you're here, looking at all aspects of the tax side, as well as when you're gone, how do you want these dollars to go efficiently to your beneficiaries?
Or even charities. We can set things up for charities. I think health savings accounts, if you're still working, are very important to be using because in retirement, not only can be used for anything medical tax-free, I think that at a certain point you can actually use it similar to an IRA. Now, we wouldn't necessarily want you to do it in that fashion. We would rather have you use it for medical. But think about even for Medicare, the gaps that they have, you could be using that money tax-free. It doesn't go towards your income, right? If you're using it for medical at that point.
Right, and the exemption on the estate tax is so big right now per person. What is it, 13 or 14 million per person? So if you're married, you're well over 25 million. You can actually give those dollars while you're alive. You just have to submit a form to the IRS, and they'll reduce that from your exemption when you do pass away. So a lot of people are saying, well, maybe we should give some of our assets away now. Why these exemptions are so big? Because those change almost year by year.
And enjoy it while you're alive, so that you can actually see them enjoy the money that you're going to get.
We had a client do that and gave it. The client's name was Rick, and he gave his inheritance to his son. And his son always wanted to to buy a bar restaurant and was going to do it when Dad passed away. So he gave it to his son. He bought a brewer company, and so then the dad could go in and have a cold one and see what his inheritance was doing for his son.
Huh. Interesting. That sounds great. So it sounds to me actually like this law provided some permanent extensions with some temporary enhancements. Would that be correct, gentlemen? Would you agree with that statement?
Give it to her to boil it down to one sentence. That's it, folks. Good night.
Yeah, what are we here? We're out of here. That's exactly right. But let's look at the quotes on permanent here.
Yeah.
We say permanent.
Yeah.
But we also know the government, and at some point in the future, they could alter that, as it always seems to happen. But for right now, the tax rates are permanent, and some of these other things have a phase out in 2028.
Yeah.
Very interesting. So again, it comes down to proper planning. People need to be aware of these changes and to make sure that their retirement is safe.
Yeah, well, I think the Maine tax bill calculator that we have is a great tool, even for all of you that have advisors out there. Use our tool with your advisors. That's how generous we are.
We're very generous.
Because it's a complex subject that, a lot of financial advisors get scared to talk about. What do they say when you ask them about taxes? Go see your CPA. Well, I was on the other side of that. When you go to the CPA, what do they say?
Go talk to your broker.
I'm too busy doing tax returns. Go talk to your broker. So you go back and forth. But so we wanted to create an easy to use tool. You can do as many. We had one client that did 20 different scenarios of ages and amounts. And I think it's a great piece to your overall plan, whether you use it with us, which we hope you do, or with your current advisor.
MaineTaxBill.com. MaineTaxBill.com.
That's fantastic. Well, Jordan, one final chance for you to talk about your book today, because I know we're going to give that away when people book their complimentary consultation. So take it away and bring us home.
Yeah, the book is, I wanted to basically a guide to help people take complex Wall Street strategies into everyday Main Street values. And it's almost 300 pages. It's a great guide to really cut through some of that Wall Street jargon. But we'd love to see you. Call the number on your screen, click the QR code, come in 2 meetings out of your life, get your own personal RIP report, RIPT, make sure that your risk is in line with what you're comfortable with, not what we are. Make sure that your income is a plan, not a guess. Make sure your portfolio is healthy, and let's jump on those taxes, get the IRS out of your pocketbook, and we'll throw in a free copy of my new book.
Jordan, thank you so much. Adam, thank you so much. To the viewers at home, that number to call is 888-462-7839, 888-462-7839, or don't forget to visit MaineTaxBill.com. Book that consultation, grab a copy of Jordan's new book. Be safe, be happy, and be blessed. We'll see you back 1 week from today on The Maine Money Show, where Wall Street meets Main Street. Take care now.